Morning, good afternoon, good evening, everyone, from wherever you are joining us in the world. Welcome to our third Joint Chartered Banker Institute Starling Trust Sciences webinar. My name is Eric Hofer, and I'm a co-founder and the Chief Operating Officer of Starling Trust Sciences and Starling Insights, and I will be your host for today. This is the third episode in a series of webinars on the topic of banking sector culture and conduct reform. If you want to go back and watch the previous episodes, they are all available on the Chartered Banker YouTube channel, as well as on Starling Insights website. In July last year, the Chartered Banker Institute, in partnership with Starling Insights, compiled a retrospective white paper focusing on culture and conduct reform efforts over the past decade to commemorate the 10th anniversary of the UK Parliamentary Commission on Banking Standards. We will be sharing a link to that report in the chat function shortly. In our previous two webinars, we focused on the experience of policymakers and regulators, and we follow that with that of global standard setting organizations. And in today's program, we're focusing on practitioners, and I'm excited to share the stage with four current and former senior bank executives from across the three lines to share their perspectives on banking sector culture and conduct reform across different jurisdictions. I'm excited to introduce our panel, but before we get started, I'd first like to set the stage for those who may be joining the series for the first time. Back in 2013, in response to the global financial crisis, the LIBOR scandal, and other high-profile conduct issues, the Parliamentary Commission on Banking Standards issued its final report, finding that banking standards and culture needed significant improvements. The Commission recommended a series of reforms to include a new senior manager regime and enhancements to governance and risk management that have had a profound and very positive impact on bank culture and governance. Indeed, many of these reforms were adopted by other jurisdictions around the world. And yet, despite this remarkable progress, in the past year, we saw the collapse of Silicon Valley Bank and Credit Suisse, and others have made the headlines for all the wrong reasons. Issues of culture and conduct are increasingly viewed as having systemic implications that are poorly understood and therefore not priced in. We have heard from supervisors who realize there is more work to be done, and the global standard setting organizations are stepping up as well. So now we hear from practitioners about their experiences and visions for the future. With that, let me start by welcoming Ian Henderson, the bank non-executive director and a trustee of the Chartered Banker Institute, Andrew Shields, also a trustee of the Chartered Banker Institute, Mark Cook, a former group head of operational risk for HSBC, and Alexandra Chesterfield, group head of behavioral risk for the NatWest Group. We'll be able to take questions in the chat function, so I encourage you to put your questions in there, and we hope to have some time at the end to answer all of those. So with that, let's begin. Why don't we start by recognizing you all have extensive experience in the financial sector. Would you please each provide some short background for our audience? Ian, maybe we can start with you.
Sure, thanks, Eric. So my name's Ian Henderson. I had a 30-year career in banking, 2/3 at big banks, Barclays and RBS, 1/3 in the UK challenger bank space with Shawbrook Bank, the Kensington Group and Arbuthnot Latham Limited. The last phase of my executive career, though, was on the other side of the fence, working for an Australian regtech business called Kicker that focused on helping international organisations tackle financial crime. I'm currently a non-executive director and 2 small UK banks.
Andrew, can we hear a little bit about your background?
Sure, Eric. Good afternoon, everybody. My name is Andrew Shields. I started my financial services career with the Royal Bank of Scotland on their management development programme and worked in various parts of the bank over a long period of time. Then held a number of senior risk management roles within the financial services industry in different sectors, followed by 7 years management consulting practice up to partner level with firms like KPMG. Then spent 11 years working and specialising as an interim chief risk officer and worked for a number of fairly high profile organisations. And most recently in my career, I was managing director and chief controls officer for the customer and product verticals within Barclays Bank UK.
Fantastic. Mark, can you tell us a little bit about your background?
I crossed some of these organizations with our fellow two gentlemen. So over 20 or so years in banking, and I played on both sides of the fence. The first part of that career was really in the first line, looking at the building out sort of a leading operational side, primarily in capital markets. The second part, I moved the dark side into the world of risk, chief risk officer at Barclays for one of the divisions. And as you alluded to, as a sort of group head of non-financial risk at HSBC, more latterly. Now I spend my time sort of really thinking about startups, primarily in a business called Risk Agora, where we're trying to build a marketplace for fintechs to address non-financial risk. And I'm now seeing some of the pains and the challenges in terms of bringing in some of the innovation, new solutions that are out there.
Excellent. Alexandra.
Hi, good morning or good afternoon. My name is Alex Chesterfield. I've had around 15 years experience either setting up or leading behavioural science teams in very different contexts, so both private organisations and public organisations. I currently lead the behavioural risk team in group internal audit, so I'm in the third line at NatWest. And then previously I was at the UK financial regulator, the FCA, in their behavioural economics and data science team. So I think I was their first psychologist or cognitive psychologist hired to be part of that team, and worked on a lot of what is now the consumer duty. I am also studying part-time for a PhD at the London School of Economics. So I really love the kind of geeky data side of this as well.
Fantastic. As you can see, we have a fantastic panel for us today. Ian, why don't I start off the program with you? What do you see as the responsibility of first-line leaders in managing the culture of the organization, and how has that changed over time?
Yeah, I guess the first thing we should say is that culture is a really, really difficult thing to define. It's often stated as how we do business around here, but what does that mean? It's obviously a very subjective statement, and because it's subjective, it's open to interpretation, which means it's difficult for first-line leaders to actually manage. I've certainly found in my organisational experience that it's the first-line leaders that are the glue that tries to join up an organisation. You know, the tone from the top comes from the board. They often state the company values, which then have to be lived and breathed by the rank and file staff. So it's the management that need to try and provide that glue that links those high-level board-endorsed statements into practical reality inside the organisation. So while on the one hand, culture is difficult to observe and measure, behaviours aren't. And I guess there's a strong link between behaviours and culture. And I think that's where the role of the first-line manager really kicks in terms of observing and measuring behaviours. Most organisations, I think, in their performance appraisal systems have componentry, clearly objective componentry with hard measures around sales and service and things like that. But equally, it's very important that there's a behavioural overlay, because it's how you go about achieving those objective measures that are important. So I think for me, that's the key role that first-line management play in terms of helping manage the culture inside an organisation. In terms of how it's changed over time, it's definitely evolved. I think in your opening remarks, Eric, you spoke about some of the I guess, the crimes of the past that have been witnessed in financial services. In the UK, going back into the 80s, the mortgage mis-selling scandal. More latterly, there were sort of complex interest rate swap products sold to simple corporate organisations. There was the LIBOR collusion that you touched on. There's been a widespread global failure to properly tackle financial crime. That is, again, as you said, has brought this into the sharp focus of the regulator, and there's no question, mostly post-GFC, the global financial crash, where there was a real deep desire to understand why so many things went so wrong in so many firms across so many countries, that I think the common denominator eventually alighted on culture. And this has definitely been focusing the minds of regulators over time. That regulatory focus has meant senior management focus, and therefore ultimately management and rank and file staff focus in organisations. So while it's changing, I think the one thing that hasn't changed over the last 30 or 40 years is the role that culture plays, the role that is required of first-line management to help manage that culture, and ultimately to bring longer-term improvements to all banking organisations globally.
Outstanding. Andrew, let's turn to you from the perspective of the second line. As an experienced chief risk officer, I'd be eager for your thoughts on this. How does culture factor into your efforts to manage both non-financial and financial risks from that position?
Well, I think certainly, from my 11 years experience working as an interim CRO, from a purely selfish perspective, there's a very high level of interest on my part before I enter or agree to become an interim CRO and hold the SMA4 regulatory registration. That it's one of the first questions I always ask the CEO and the senior execs in the firm. How would you describe both the general culture and specifically the risk culture within the organization? Because I think that's an extremely revealing question. And sometimes if you get a whole variation of answers to that can ring alarm bells, because it would maybe indicate that people are not aligned as to the set of values and principles that they work to when managing risk, and their attitude towards risk and the organization's risk appetite adherence. It can suggest that there are perhaps problems there. There's that famous book out there entitled, rather disgustingly, "The Fish Rots from the Head." And I think that's very true in terms of a poor risk culture in the organization. If the right messages aren't coming down from the key execs like the CEO, the CFO, CRO, etc., to the business, that's often an indicator that there are a lot of problems there, potentially problems of lack of alignment. I think one of the first things that I like to do when going in as an interim CRO is to hold a sort of mini education program within the business, to a greater or lesser extent, depending on how well risk is embedded in the firm, and making sure that the key messages get out there to the staff and the senior execs and management, that the management of risk is everybody's job within the organization. It's not the risk function's job. They're there certainly to facilitate the process of identifying, assessing, controlling, monitoring, reporting on risk. But at the end of the day, it's the people in the first line of defence who are responsible predominantly for managing that risk. And it's basic things like what's the level of tolerance within the firm to not adhering to policies and procedures, and getting the word out that if you start to unnecessarily draw the attention of the regulators, that is a very negative thing for the organisation. And also the fact that if your organisation falls out of favour with the regulators, it can have a negative impact for everybody who's working there. Things like it can negatively affect career prospects, pay rises, the ability of the organisation to pursue its strategy, through fines or censure, etc. So I think once you start to make those connections in people's minds, particularly the more junior staff, it's often a light bulb moment that, risk, they realise that risk is actually everybody's responsibility for managing. And just finally touching upon what Ian was saying, it's extremely important to have checks and balances within the HR and remuneration structure to make sure that there are sort of punishments, if you like, for non-adherence to policies and procedures. For example, having bonuses or pay docked or whatever as part of the remuneration process. So it's a very critical factor, certainly in my role as a chief risk officer.
Fantastic. Mark, you also have a bit of a perspective from the second line, but you spend a lot of your time looking at non-financial risks. So maybe we could spend some time looking at that. What is the role of culture in that area of risk, and what sort of culture supports good outcomes? And we've seen regulators seeking to try to focus on behaviors and tracking, recording behaviors. And does that inevitably lead to more enforcement in this area around that?
So first of all, I mean, non-financial risk as a stripe is really interesting. I think banks have had, centuries of experience arguably managing credit risk. and certainly decades of experience managing market risk and possibly liquidity risk, albeit, maybe the acts of SVB may bring that into question. But non-financial risk is something you see in every single vertical out there in any single industry. It's the things that go wrong when your business is not well managed. And it spans everything from the areas where we've seen real pain for banks, and certainly with HSBC, so a lot of pain in financial crime, but also conduct, cyber, way we contract, customer outcome, all of that comes under the banner of non-financial risk. And here this is where I think culture really plays a phenomenal role. If culture is collective behavior, I think we've all touched on that, then it is the most powerful agent in creating either good outcomes or bad outcomes. And I think when you look at good outcomes, what are you really after? You're after a set of collective behaviors where people are aware of the things that can go wrong. And often that needs education, because these are large, complex organizations facing a myriad of factors to run themselves well. So that awareness needs training, it needs education, but it also needs ownership. It needs people feel that they're there to act and get good outcomes, get the right outcomes to the customers, but also make sure that they avoid the harms and failures, and also that they feel empowered to act. So we've got the regulator. If we touch on our last point, they're leaning into that, and they're intervening in that space of really the individual and their accountability. And I think that's quite helpful, but also you need to be a little bit careful. There's a danger we overstick this and we create things like blame culture. I think, what I think even the regulatory world would say is they want to see that ownership, but they want to see that ownership coupled with reasonable steps, that the actions of individuals do the right things, but also actually are quite important that they ensure they actually act and that they actually take action. Often I think some of the biggest failures that I saw, some of the human factor issues that we encountered in some of the areas where we hadn't got it right were due to acts of omission, where people didn't actually seek to ask the questions they should have asked at the time, didn't actually seek to drive certain actions when they could have in order to prevent. So, generally, culture is something that is often not given the attention it deserves in order to build great organizations. I think when we are seeing, and we have seen the banking sector, a move to create more ownership, to put this more at the heart of the agenda. And I think that is a good thing, but I also think there's more to do in that space.
Alexandra, let's turn to you then. You bring a particularly interesting perspective and background on this. So NatWest brought behavioral science into the internal audit function. Can you talk a little bit about what led to that and what's the primary goal of having that in the audit function?
Yeah, sure. Yeah. I wanted to start actually with a story from my time at the FCA, I think, which will provide a decent context to the wider team set up in audit in NatWest, because you wouldn't normally put those two words together, internal audit and behavioural science. So back to the FCA, the team I was in, we were trying to diagnose problems across the pawnbroking market. We had lots of descriptive statistics on the volumes and the amounts and the kind of market as a whole. But we wanted to really spend the day in various pawnbroking stores to really understand the reality on the ground for both customers and staff. And I always remember it was one branch in the East End of London somewhere, and one of the staff, Cindy, was talking me through the process to onboard a new customer. And Cindy had to use 15 different computer systems to onboard a single customer. None of those systems talk to each other, so Cindy had to input the same information each time to those systems. She also had to read 60 pages in a PowerPoint document with size 8 font to learn how to use each of these 15 systems. Meanwhile, behind Cindy on the wall in the back room of the store were performance league tables of how each of the staff were meeting or not meeting their targets. So a bit like a football league table, from the top to the bottom, how are people doing? And the incentive, the reward for hitting your targets was a holiday to Ibiza, which looked amazing. But clearly for Cindy, and I've kind of made Cindy up, but she was a real person at the time. Clearly Cindy is going to prioritize hitting her targets and the potential of a holiday to Ibiza than trying to do things properly. So she was incentivized effectively to find workarounds than following due diligence to onboard a customer properly. Now, the point is that these systems and processes that I've designed for somebody are designed for a robot. They're not designed for Cindy. They're not designed for people like you and me. They're not designed for humans. They're designed for robots. And the key message is that this drives risk for organizations and poor outcomes for all of our customers. So taking a step back, so much of how organizations and markets are designed is based on the idea that humans are rational, that we weigh up risk and reward, that we read, we have an unlimited amounts of time to read all the documents. And this is the basis for law, for risk, for compliance functions, and also for many traditional audit functions as well. But it is flawed, not all of the time, but at least some of the time, as shown by all the failures that my panelists and you, Eric, opened with. So the field of behavioural science is a bit of an umbrella term for many different disciplines within behavioural science, so economics, psychology, political science, etc. Basically uses empirical evidence, so what people actually do, so how they actually behave, what drives those behaviours, not how we think they behave or how we'd like them to behave. And we can use that body of science, which is quite old, to update and design organizations and markets, if you're a regulator, for better results. That's I guess that's the context. So back to NatWest, the team was probably set up about 7 or 8 years ago by a previous chief audit exec who had spent most of his career in Goldman Sachs and had seen many things go wrong and had come to the conclusion that when things do go wrong, the root cause was at least partly behavioral. So he wanted an independent expert team in internal audit that could assess behaviours across the organisation. And rather, audit is normally associated with more of a backward view, whereas he was like, actually, if we can understand what's going on scientifically and empirically, we can hope to get more of a forward view of what might be coming down the track rather than a backward view once something has gone wrong. So behavioural risk, which is what we call it in NatWest, and it's definitely a growing term. So there are now many teams in many countries that have behavioural risk teams. It's basically a forward-looking, data-driven, a more human-centred approach to how we manage risk. I don't think it's a substitute for other types. It's complementary to the other lenses and traditional risk management approaches. So the purpose of the team that I lead, behavioural risk team in audit, is really to reduce the risk of poor outcomes for the organisation and our customers that arise from behavioural root causes. That's what we do in a nutshell, and how we do it. We can talk about that later perhaps, but in summary, we use a whole range of methods and tools from the behavioural sciences. So one day it could be like a fly on a wall, observing ExCo meetings. The next day, we could be analysing millions of data points on how our colleagues make decisions or how our customers make decisions and the outcomes they get.
Fantastic. So, Ian, let me bring it back to you now that we've gone through each of the different lines and seen different perspectives. There can sometimes be a bit of an adversarial relationship between first line, second line, and third line. And how do you think that impacts the efforts we're discussing today? Particularly in managing culture and conduct risk more effectively?
No, I think you're spot on. I think there's a very real risk of adversarial relationships between the various lines of defence. That said, nobody likes they're getting their homework marked or being inspected, so that's your starting position. But it need not be adversarial. I think mature, well-organised companies with strong cultures can embrace the challenge, the two-way and three-way challenge that you get through a typical 3 lines of defence model. It's all right to agree to disagree, and not all the findings of the second line on the first or the third line on the first and second might be universally held, but I think the process of dialogue, conversation, fact-finding, assessment of those facts, etc., should enable the organisation to cope well with the challenge of those inspections, because ultimately all 3 lines of defence have got one common goal. It's the long-term success of the business and the support that they provide to all of their stakeholders. So in that sense, they've got a common starting point. But the reality is that once you start to inspect different aspects of a business, whether it be second line on first line or the third line, more generally, then there is a risk of tension, and it's how that tension itself is managed. And again, if the culture is bad, then that tension is probably not effectively managed. Whereas if there's an open, constructive, dialogue-based culture, then you can find a common path to a solution ultimately. So part of it's organizational maturity, part of it's organizational attitude, part of it is, as we've discussed earlier, the tone from the top, what's coming down from the board, the extent to which the third and second line are supported by the sort of senior echelons of the organization. But ultimately, I think the challenge here to avoid the adversarial piece is how the second line and third line go about their business. There is a danger that, it's not just a sort of prod in the ribs, it's a chopping off of the head. So it is how one in the second and third line engages, reports, and ultimately, communicates their findings, I think is pivotal. But ultimately, a strong risk culture in first line should welcome these second and third line reviews. And if they do so, it will reinforce openness, it will reinforce transparency, it will enable it to be a two-way dialogue. The danger is it's a one-way dialogue from second and third to first. It should be done effectively in a two-way manner. And if that happens, then I think the adversarial risk that you alluded to in your question can be mitigated and can potentially disappear.
No, absolutely. I guess good culture begets good culture, in a sense. Alexandra, turning back to you, yeah, I mean, it's a good point. Like, there's very rarely has there been somebody who said, "Hey, good day today. Audit is here." So it's can you elaborate a little bit on the benefits and potential drawbacks of embedding a function like this in internal audit, and how do you manage from that perspective?
Yeah. So first, just for clarity, I've never chopped off anyone's head. But I think actually, sorry, on a more serious note, Ian, you are spot on. When I get around the table with my stakeholders, one of my first messages is always that common alignment. So at the end of the day, we all want to preempt future issues, and we're all here to drive sustainable growth for the organisation. And setting that scene, and that we all have that common goal, really helps. But back to your question, Eric. So I think there's two benefits and two potential drawbacks. So on the benefits, I think one is the independence. So unlike other behavioural science teams that might sit in a first line or even perhaps second line, we don't have to be commissioned to do the work. We don't have to ask permission. I mean, it definitely helps when we have good stakeholder relationships and we can come in without an issue, but we don't have to be asked in. So we're independent. We can say, look, we've assessed this risk. We want to come in and do this work, and we need X, Y, Z. The second benefit is the impact that you get to have when you sit in the third line. So I think it's a real privilege. We get to work across the whole organisation. We interact with stakeholders that have the kind of influence and the senior decision-making authority actually to change stuff day to day for colleagues, but also for customers. So the work can make a difference. That's the main point. The work is also difficult to ignore. So again, asking consultancy in, you get an interesting report, you can put the report on a shelf. Again, when a team comes in from audit, the benefit is you have to do something with it. You can't walk past it. You can't ignore it. So, for example, we've done work around the design of around payment journeys, not the design, but assessing the design of payment journeys to reduce the risk of our customers getting frauded. Or it might be, again, assessing the risk of the way targets are designed. And change happens off the back of that. And that's really motivating and really impactful. And that's essentially why we're here at the end of the day. They're the two benefits. The drawbacks, the potential drawbacks of having a team like this in audit, again, I think there's a couple. So one is that behavioural science it's not a new field in kind of academia, but it's a new field in the context of organisations, and particularly in a risk and audit context. So often we're met with confusion. So we'll get stakeholders saying, "Hang on, why are you not here looking at my controls?" So often we have to do a lot of kind of explaining and education. The other reaction is delight. So actually, Eric, yes, I think you're right. Often people hear audit and they're a bit like, "Oh, great, I'm going to have a really good day." often actually, once they hear about behavioral science, actually it's the opposite reaction. It's like, hang on, why are you in audit? Can you kind of come in, why aren't you in my business, essentially? So often it's quite polarized reaction. So how we get around that is, we do a lot of work outside of audits to explain and educate on what this science is, what it does, what it means, and that we are not here to assess controls. And often we will work with our audit colleagues on integrated pieces of work. So again, from the stakeholder perspective, they get the value of the traditional controls and risk-based audit, but then also what happens around that and what the outcome of that control or process is. What's the impact of that on our customers or colleagues? So that combined perspective, again, it can be very valuable for the business. The second drawback is, in my experience, when any of us have an issue with a contract, we call a lawyer. If we have an issue with our IT, we get on, an issue with our computer, we get on the phone to IT. But in contrast, I think because we are in the business of understanding humans, often I think everyone attributes what they do and how they behave. They think, oh, well, I therefore understand what my teams are doing and what my customers are doing, which isn't always the case. Often people have good intuitions, but that isn't always backed up by the data. So I think where the challenge comes in is when we come in with, various buckets of evidence pointing to an alternative hypothesis or explanation of what's going on that's counter to what the stakeholder thinks, that can be challenging. So again, how we get around this is, I think often that the kind of rigor and the data-led approach helps. We try and keep it, we keep it as objective as possible. That's the point of it being behavioral science. It's not subjective. And we also put a lot of time and effort into building relationships outside of audits. And that's relationships with business stakeholders, but also critically our counterpart teams in the first and second line. So we are consistent and delivering consistent, where possible, consistent messages. And if we disagree, then we will figure out a way of why we disagree and what's the message then we want to project to the business. So focusing on relationships outside of audits, that really helps again to I guess bring that value.
Fantastic. Just to remind, if there are any questions from the audience, please go ahead and put those into chat and we'll look to respond to those later on. Another thing that's changed in the last 10 years has been quite remarkable is the technology front. Andrew, maybe turn to you. I'd be curious in your perspectives. Many have called for these technologies and adapting to these technologies to help banks to manage these risks and to help supervisors to regulate them. How has that developed over the last few years, and what do you see for the future of regtech and compliance tech, and how are senior risk audit and compliance professionals responding to this new world?
Sure, it's certainly an exciting and a fast developing area, and I'll also be interested to hear Ian's views on this, because Ian, I think, is closer to this subject even compared to me. I think having set up and run a firm that works in this particular area. So these are my observations as a practitioner. I think it's important, first of all, just to maybe pause for a moment and define what we actually mean by these terms reg tech and compliance tech that are often bandied about. What specifically are we talking about here? I mean, the way I would define this is reg tech and compliance tech uses sophisticated data analytics to sort of streamline compliance, automate processes, and enhance regulatory management for financial institutions. And it does that through the use of a lot of developing and emerging technologies such as artificial intelligence, machine learning, and blockchain technologies to help financial institutions with the regulatory monitoring and compliance. And that's usually provided to these firms through software as a service, or SAS as it's referred to. So how have these technologies actually developed? I think one of the primary factors that has speeded up the uptake of these technologies was in the sort of post global financial crisis environment, where the number of regulations that are being introduced, I mean, I think if you look at it from a global perspective, there's something like 200 new regulations introduced globally every day. So the sheer volume of regulatory compliance has gone up enormously for regulated firms. And I think these technologies have developed largely by harnessing advances in things like artificial intelligence. And certainly from my experience, I think the focus is for these firms has been on trying to automate particularly repetitive, time-consuming processes that were previously undertaken by individuals and compliance departments, for example. So some of the more popular areas are things like the take-on of new customers and due diligence around that, financial crime and anti-money laundering analysis, fraud detection. One example that I saw that was very effective in a large bank fairly recently was the detection of fraud for the take-up of the government's bounce back loan scheme after the COVID lockdown, trying to trace people who had fraudulently applied for these loans and then subsequently misused the proceeds of the loans to buy new cars or something like that, things that it wasn't intended to be for. So these technologies certainly can help firms undertake a lot of these repetitive and time-consuming processes in a fraction of the time that it would take a human being. So your other question was, what's the future for regtech and compliance tech? I think these technologies certainly can provide valuable cost savings and help firms cope with the pace of regulatory change. However, having said that, I think their use also can increase risks associated with cybersecurity and data protection, because sometimes the amount of information and data that firms need to store as a result of using these technologies goes up. I think there's definitely an increasing take-up of these technologies, to help with repeatable processes. I think in the early days there was some concern that these technologies were coming in and doing people or would do people out of their jobs. I don't think that is the case. My personal view on the use of these technologies is that they can actually, due to the data analysis that they undertake and the richness of that analysis, in some cases, it can enhance rather than eliminate people's jobs, because it allows them to work on a richer source of data, having been through that analysis process, first of all. But obviously, in response to firms using these technologies, there has been an increase in what's referred to as SUP tech, which is supervisory technology, which can be used by the regulators to actually supervise the processes that are being undertaken in firms using these technologies. I think it's also important to remember that from a regulator's point of view, and I'm sure Alexandra will chime with this view, that although the use of these technologies is wonderful, from a regulator's point of view, the decision-making processes and the algorithms that are built into these technologies, there has to be a level of auditability about them, and a movement away from the concept of a black box that, when the regulators come in, nobody in the regulated firm can necessarily explain what decisions are made by that black box, and clearly that, from a regulatory perspective, is not an acceptable state of affairs. So things have to be transparent, understandable, and auditable at the end of the day. You're also asking about, how are senior risk audit and compliance professionals responding to this changing work environment? My observations in the early days, and we're going back quite a few years now, are that I think in the early days there was probably a level of healthy skepticism about the take-up of these technologies a number of years ago. Again, harking back to my earlier point about, I think some people were worried that they were doing themselves out of a job by adopting the technologies, whereas I would disagree that that's actually the case in many situations. However, I think there is a much wider take-up of these technologies now, even amongst the tier 1 banks, as well as the fintech organisations where there's less resistance to the take-up of technologies. And I think generally there needs to be a high level of senior management buy-in to actually want to take on these technologies in the first place. And often they're introduced as part of an overall wider digitalization program within the organisation. So I think to sum up, I would say that these technologies have a very bright future. I think there's a greater level of acceptance generally among senior management and the three lines of defence of their usage. But going back to the point I just made there has to be a level of auditability, understandability and transparency throughout the entire process. But I would also be interested to hear Ian's views from a direct practitioner point of view of having run one of these firms.
Yeah, happy to chip in. Thanks, Andrew. And I guess in many respects, you've stolen my script. A lot of the points that you've just made are the points that I would have made, having been a gamekeeper turned poacher with my work at Kicker, which was designed to do all the things that you said. The one thing that banks have got no shortage of is data. What they do run short of is information. It's how you draw those strands from the data points that give you things that you can act upon. That's what I mean by information. I think the point you make around the sort of workforce view of these technologies is really important, because for the organizations that I worked with, they actually embraced it, because it actually meant that the grungy low value add jobs were taken away by the computer and by the data analysis, and it left them to do the more exciting value additive elements. So for example, my world was that of combating financial crime. It wasn't just about data acquisition, it was about what you did on the back of the data you acquired. So which meant actually most compliance operatives jobs were actually enhanced by this, because the grungy thing that took them half a day to do was done in 5 minutes, and then they were doing the value added analytical piece on top. There has been, though, a challenge for organisations to embrace this. That part of it is because certainly the international banks I was dealing with had complex organisational structures, often managed on matrix basis, which made it difficult to get to decision makers. And it meant that fiefdoms were established. I guess Mark will experience that at HSBC, and it's how you actually get to the ultimate decision maker to demonstrate and ultimately get them to embrace the technologies that you're bringing. I think that's probably a common gripe by most regtech businesses. Getting to the actual decision makers in organizations is a challenge. So it's usually very easy to sell to the chief risk officer or the head of compliance. It's getting it up the food chain is the challenge that I certainly found.
Excellent. Let's continue this. Mark, you oversaw the implementation of this technology when you were at HSBC, and you've engaged with many more providers since in your current role. So, and do you want to elaborate a bit on the promises of technology in this regard?
Yeah, no, I was nodding ferociously at Ian's comments, which were spot on, actually. So first of all, I'll declare my colours. I'm absolutely a huge advocate for risk and regtech adoption. I think it promises a lot, not just in terms of efficiency, but I think it does help make our organizations and banking more efficient, but also I think it promises a lot in terms of the capabilities we can bring to bear to make these organizations more sustainable and less likely to fail and cause harm. Now I'm going to be a little bit negative and say, I think there's a bit of a two-speed economy, and I wonder if Ian saw a bit of this, in the sense that I think the propensity to experiment, innovate is greater in our first line than it is in the second line. We've seen a lot more of the digitalization agenda within the first line, much more partnerships with fintechs, looking at how we can, make the services more effective, more all-time deliverable, changing the channels and the like. And with that digitalization, I think we've seen a little bit of this sort of emergence of, you've got digital businesses where we're trying to manage them from risk and compliance perspective in an analog way. We haven't seen, to my mind, risk and compliance keep up with that shift and that use of technology in banking. And that's not because we don't have availability of data. I agree with Ian, we've got lots of data. And we've certainly now got the technologies. And I suppose, and maybe that's where I think the promise comes. I think we're on the cusp now of seeing a revolution in risk management. I think we're going to see a move from the mechanicalistic arms and legs, skilled practitioners detect and correct, into using these technologies to allow us to predict and prevent. Not necessarily replacing humans, but doing a lot of that pattern recognition, augmenting, at scale, that low cognitive activity, so you can bring the high cognitive activity to really help businesses ensure they design their services to deliver and make sure they deliver the outcomes that our customers want. And that's exciting. And I think we are seeing, I don't think that revolution's coming from within the businesses, from within our organizations themselves. I think it's quite hard to innovate from within, but we're seeing, like as Ian's been involved in, a whole set of fintechs out there that are driving and developing these solutions. There's huge growth in risk and regtech, but it doesn't land as well as it potentially could. And I think it's describing it's almost the problem of these idea providers, people who are providing thin crime solutions, cyber solutions, like that, crossing the chasm to deliver those into these organizations is hard. There are huge barriers to adoption. And that's certainly what I experienced as a buyer in a large organization, and trying to, Ian was spot on, trying to bring that in and negotiate amongst all the various different business lines was not easy at all. It actually became a Harvard business case study. But I don't think it became a case study because it was atypical. It became a case study because actually what I encountered was exactly what other businesses out there encountered. We were trying to bring in behavioral analytics, a really exciting solution, fantastic sort of entrepreneurial and innovative team that we were working with, a small fintech in the US. It took me 2 years and 44 sign-offs to finally get them through the door. And the second thing you find when you're trying to innovate and really bring in new technologies is it's not just a plug and play activity. You have to be prepared to be a design partner in that process. And that in itself is quite hard. And it makes some of the challenge in terms of bringing these solutions in. Yet they offer huge gains. I don't think we can believe we can manage digital businesses in analog way. I don't think we can throw more arms and legs at it. And what we're seeing with technology and the pattern recognition, the telemetry that we can put in these businesses is an opportunity just to make our banking much, much better than where it currently is. So I think that's the future. I think this wave is coming, but it has got a number of challenges that I think some of the other speakers have alluded to.
That's fantastic. And so again, if there are any questions from the audience, we'd be happy to entertain those in the chat. I actually have a couple of questions that have come to mind following along with this remarkable conversation. And just feeding off of this, Alexandra, I wonder on this bit of technology, one of the incredible innovations we've seen in the last year or two has been around ChatGPT, these large language models. And between the amazing technology advances and an intense competitive push to see these implemented in banks, in commerce in general, that creates a really unique opportunity. And I'm reminded of your analogy earlier about, people are not robots. And now we're talking literally about robots, putting robots in the bank. I wonder if you have some thoughts about what that means, because clearly AI is a technology that we want to embrace, we need to implement for the betterment of our companies and our society as a whole. But there are certainly risks along the way and certain governance implications of that. Do you want to offer any thoughts on that?
Yeah. No, I mean, I was reading a study the other day that asked thousands of people to differentiate between job adverts, online dating profiles, and hospitality, Airbnb type adverts. And no one could distinguish whether the advert was written by a computer or whether it was written by a human. And that's the point, isn't it? I mean, GPT, these large language models, can impersonate humans incredibly well. That obviously brings many risks, many of which have been pointed out. So the explainability, the black box, obviously the bias that it just replicates from how humans, on aggregate make decisions. But that same capability also brings many opportunities. So with my, I think, research hat on, I see many opportunities to use these large language models to better understand, assess organizational culture, and then what risks and also what opportunities that might lead to in the future. So around I think 80% now of data that is in organizations is unstructured data. So by that, I mean text, audio, images. So a large proportion of that is text. And this is what we can use large language models for, to analyze in an objective and empirical way. So yes, clearly there are lots of risks that need to be managed, but just as Mark was saying, it offers huge opportunities. And actually, a lot of the work I'm doing on the PhD side in the lab at LSE is looking at studying exactly this. And then critically, not just, well, what are the patterns that we can see in particular organizations, but also what link does that have to outcomes that we care about, whether it's financial outcomes or whether it's risk events or customer outcomes like customer satisfaction. So I'm kind of on the sunlit upland side, but caveat is, yes, obviously, clearly, there are many risks, and this is where the traditional, risk management lens can help with as well. What questions we need to be asking, what guardrails do we need to put in place.
Fantastic. I'll allow anybody else that's on the panel who would like to weigh in on that, but if not, I had one other question that I will also open up to anybody who's interested in responding. In the wake of the analysis, post-event analysis of Silicon Valley Bank and Credit Suisse, a lot of attention was focused on the supervisors themselves and their effectiveness in dealing with banks and their ability to help banks to make the right decisions. And so it would probably be an oversight for us to not at least consider what kind of ways do you think that the supervisors could be more effective engaging with banks on these topics, topics of culture and conduct risk, particularly where there aren't hard and fast rules and there's not clarity around the metrics used to evaluate these things? Are there ways that supervisors can improve in the way that they engage with banks and vice versa?
I think if I can maybe step in just for a moment, Eric. I think traditionally and particularly in the post-global credit crisis environment, we've seen a real tightening of global regulation, from the Basel Committee, etc. The tightening up of and the increases in the level of capital, etc. that banks are required to maintain now in order to protect their customers and depositors. That in itself is clearly a good thing, but I think that, if you look at some of the more recent bank failures, a lot of these banks didn't collapse necessarily through a lack of capital, but there were other areas that, had they been looked at, maybe would have given a hint that there were problems with those banks. For example, the analysis of share prices of banks often shows that prior to a bank failing, there can be a sudden decline in the share price. There have been discussions also recently, particularly in the Financial Times in the UK, about more or additional risk-sensitive elements being added to the overall supervisory or regulatory process. Things like we've discussed today, like cultural measures. It's a difficult thing to put numbers around in terms of, how healthy is the risk culture, for example, in an organization. But I think there are measures that can be put in place that might help flag up earlier that a regulated firm is maybe in difficulty. And I think also with the advent of the consumer duty, I think the regulators are looking more closely than ever at the way in which organizations are interacting with their customers. And that can often be an indicator of, say, poor or toxic culture within the organization, which can be a factor. So I think the point I'm making overall to sum up here is that I think there are additional, in addition to capital holding for banks in particular, there are other risk-sensitive measures that it may be worth considering to take into account when assessing the stability of banks and other FS organisations. I don't know what other people think about that.
I had two points on this. So one, I think there is an opportunity for regulators to use some of these advances in technology and computational power that now exists, and just the amount of text that both customers, consumers, and banks leave behind day to day. So this digital trace data, as it's known. So this offers a huge opportunity for regulators to understand organizational cultures from the outside of an organization. And this has been done. And the link between that and risk events, is documented. So there's some brilliant research by the LSE and the Bank of England, for example. They can use, Glassdoor data, customer trust pilot data, customer reviews, incident report, complaint data. So it's a whole kind of radar that you can build out. So this offers a huge opportunity, I think, for regulators to use. And then that allows them to become more effective because they can focus their limited supervisory resource, the high value tasks, on then targeting and zooming in on firms that have these indicators of riskier or poorer cultures. The second point I wanted to make is I think actually regulators looking more inward at their own organizational culture and what behaviors exist there that perhaps allows, or not allows, but facilitates some of these crises to happen. So when you look back at when things have gone wrong, often the regulator or someone in the regulator or groups in the regulator were aware of issues, they'd raised red flags, but for whatever reason, they'd been ignored or silenced. So again, I think there is an opportunity for regulators to use some of these tools and insights, but on themselves, to really hold that mirror up and ask themselves, to what extent do we have a healthy culture, accept challenge, etc., to do our job and fulfill our purpose.
Fantastic. Any other closing thoughts before we finish?
No, so the only thing I would observe regulators, I think regulators are as well, because they don't necessarily always use their strength to help the industry drive good outcomes. And so what does regulator have advantages that a single firm doesn't have? They can see collective behavior or collective practice, and they can mobilize a community around doing things differently. And they do that with some of their shifts on policy and some of the practices that they instill. But they would do that a lot better, I think, if they were a bit more collaborative and sometimes with the banking sector, and if they were sometimes also a little bit more prepared to nudge innovation about how people actually manage risk and sort of nudge some of these better ways of doing things towards the bank, so that there was a lower risk of adoption. I think so that would be to my mind where regulators can sort of perhaps lean in a little bit more to driving this revolution, and in doing so, I think they'll get better outcomes, which they seek to get in terms of having a more healthy financial system.
Just one closing thought from me is that I think the regulators are trying. Having sat now as a non-executive director on a couple of UK boards, for example, they now attend, risk committee meetings and board committee meetings. Now, I absolutely accept there's a danger that they could be stage managed given the audience. But that said, they're actively engaged, and I know for certain that they read in detail, the minutes of meetings, etc., between those sort of set piece visits. And we certainly saw in organisations I worked with, quite active dialogue in the back of them reading what was happening inside the banks I was working with. So, I think that they are trying hard in a difficult and challenging environment.
Fantastic. Well, I'm afraid that's all the time we have for today. So I'd just like to close by thanking our guests, Ian Henderson, Andrew Shields, Bart Cook, and Alexandra Chesterfield for their time, and thanking all of you, our audience, for joining us online today. I hope you enjoyed today's webcast. It will be available to view again via the Institute's YouTube channel shortly, as well as on the Starling Insights website. And if you enjoyed it as much as I did, then please feel free to share this webcast recording more widely via your own social media. Please keep an eye out for more on these topics in the months to come. But for now, thank you and goodbye.